Ladies and gentlemen, good day and welcome to Q4 FY23 earnings conference call of HDFC Asset Management Company Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. From the management team, we have with us Mr. Navneet Munot, Managing Director, Mr. Naozad Sirwalla, Chief Financial Officer, and Mr. Simal Kanuga, Chief Investor Relations Officer. I now hand the conference over to Mr. Simal Kanuga, who will give us a brief, following which we will proceed with the Q&A session. Thank you, and over to you, sir.
Thanks, Nirav, and good evening, everyone. Let me start with data on the industry. QAUM for the quarter ended March 23 was rupees 40.5 trillion, a 6% growth on YOY basis. Net flows during the year in equity-oriented funds added up to rupees 1801 billion, of which rupees 1618 billion was in actively managed equity-oriented funds and balance 184 billion in equity-oriented index funds. So if one looks at net flows, index funds constituted approximately 10%. The number for gross flows, though, would be materially lower. One more data point on actively managed equity-oriented funds, which might be of interest, is flows via NFOs. During the year, industry collected approximately rupees 342 billion via actively managed equity-oriented NFOs. That is nearly 21% of the net flows into actively managed equity-oriented funds during the year. The corresponding number for FY22 was rupees 748 billion, which was nearly 34% of the net flows into actively managed equity-oriented funds during the previous financial year. SIP flows continued their growth trajectory and came in at rupees 143 billion for month of March of 2023 versus 123 billion for March of 2022. SIP flows for FY23 clocked rupees 1.56 trillion, nearly 35% of industry's gross active equity flows. Comparable number in FY22 was rupees 1.25 trillion and nearly 23% of industry's gross equity flows. In terms of QAUM, actively managed equity-oriented funds stood at rupees 19.38 trillion and equity-oriented index funds stood at rupees 0.52 trillion. Now let's move to debt. During the year, debt funds including debt index funds and debt ETFs saw outflow of rupees 582 billion. If one eliminates flows into debt index funds and ETFs, the number is much higher, outflow of rupees 1569 billion. Liquid fund QAUM grew by 8% YOY, adding rupees 0.42 trillion. Net outflows in liquid funds during the year were to the tune of rupees 510 billion. Others, which include ETFs, arbitrage, and FOF investing overseas, grew by 13% on a YOY basis. Industry recorded 37.7 million unique customers at the end of the fiscal year. Individual investors came in at 58% of the monthly average AUM for March 2023, and folio count for individual investors increased to 145 million from 129 million a year ago. We now move to us. We closed the quarter with quarterly average AUM of rupees 4498 billion, a growth of 4% YOY. Our market share in quarterly average AUM was at 11.1%, and the same excluding ETF was at 12.5%. Our actively managed equity-oriented AUM market share based on quarterly average AUM is now at 12% and 11.9% on closing basis. We have seen some uptick in recent past. Our market share for quarterly average debt AUM, including debt index fund, was at 13.3%. Quarterly average liquid fund AUM market share stood at 13.1%. Our asset mix further shifted towards equity, and it now accounts for 54.4% of our QAUM, relatively better than that of the industry. We recorded 6.6 million unique investors at the end of the quarter ended March of 2023. For the quarter, that is Jan to March of 2023, we processed 13.14 million systematic transactions, totaling to rupees 50.4 billion, compared to 12.02 million transactions totaling to rupees 45.2 billion in the quarter ended December 2022. It is important to look at quarterly data here, as February is a shorter month and we tend to see some overflows from Feb to March. For March of 23, we processed 4.53 million transactions, adding up to rupees 17.1 billion. The number for March 22 was rupees 12.3 billion. So this month, March of 23, we did process systematic transactions in terms of value of rupees 17.1 billion. The comparable number for March of 22 was 12.3 billion. In continuation of our commitment to expand product portfolio, we launched 2 equity-oriented thematic stroke sectoral funds, 1 long-duration debt fund, which saw healthy interest, especially in the end of March, and range of passive strategies, both across equity and fixed income side, during the year that went by. We announced first close of our HDFC AMC Select AIF FOF on 31st March, with commitments adding up to rupees 400 crores. The number is definitely encouraging, especially in current market conditions. We'll continue to raise further capital in this fund and have some healthy pipeline in place. Now we move to financials. We closed the quarter with profit after tax of rupees 3761 million, a YOY growth of 9%. Total revenue grew by 10% to rupees 6378 million, while operating revenue grew by 5%. We ended FY23 with profit after tax of 14239 million, a YOY growth of 2%. Total revenues grew by 2%, while the operating revenues also increased by 2% YOY. On the employee cost front, it stood flat at rupees 3127 million as against rupees 3122 million in the previous year. If we consider the number excluding non-cash charge on account of ESOP, it stood at rupees 2726 million as against rupees 2489 million in the previous year, a YOY increase of 9.5%. In terms of other expenses, we have seen an increase of 18%, or in absolute terms, rupees 348 million. This can be principally attributed to expenses that we've incurred for our business promotion, travel, digital assets, IT infrastructure, amongst others. Our operating profit margin as a basis point of AUM stood at 35 basis points for the year ended March 31, 2023, with operating revenue margin at 49 basis points. The board earlier today has recommended a dividend of rupees 48 per share against rupees 42 per share, translating into a payout ratio of 72% as against 64% last year. This is of course subject to shareholders' approval. We would like to highlight, and you might have seen in our exchange release, that the Nomination and Remuneration Committee of the board has approved an ESOP plan whereby 1.05 million shares will be offered to eligible employees at closing price as of yesterday. Thank you very much for patient hearing. Navneet, Nauzad and I are very much available for questions from here on. So Nirav, if you can kind of start building on the question queue, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Swarnam Mukherjee from B&K Securities. Please go ahead.
Thank you for the opportunity, sir. I have 3 questions. First, on the yield for the quarter. So the yield has gone down slightly on a sequential basis. There was an expansion.
I'm sorry to interrupt you. May I request you to speak through the handset, please?
Yeah, is this better now?
Yes, slightly better.
Yeah. So, sir, my first question is regarding the yield. For the first 9 months, we were around 50 basis points plus in terms of the yield, and this time we see a slight compression in that. So just wanted to understand, would this be entirely a function of product mix or any kind of impact of the debt mutual fund related taxation change that has happened, or anything else to read into this, or maybe something like more incremental flows in the balanced advantage fund, and whether there could be any impact of that? That is the first question. In terms of the trade receivables, so the trade receivable numbers have remained around 180 crores in first half, and also now the balance sheet that has been released. This number was about close to half of that in the previous year. So what should I read into this? Why has this number increased? And thirdly, related to the ESOP plan that you have mentioned, so if you could give some guidance on what could be the charge on P&L over the next couple of years?
Thanks. So the first question on the this quarter, Jen. So firstly, this quarter was 90 days as against 92 days for the December quarter. So revenue per day of December quarter was 6.08 crores. So 2 less days this quarter would mean a loss in revenue of little over 12 crores. And we have had some year-end adjustments adding for unabsorbed cost of B30, which was debited during the quarter at fund level. I think this explains the difference broadly. And as you rightly mentioned, I mean, maybe the product mix, etc. But largely, this explains.
Sir, if I could follow up on that, unabsorbed costs, sir, if you could give a little bit more color on that related to the B30 that you mentioned.
Sorry, you're talking about the cost or margin?
So in the margins, you said there is some impact from the B30 red assets, right? So if you could just highlight on that.
That's just 1 basis point, right? Overall, is very
right.
Yeah.
Right. So just wanted to understand whether, say for example.
Swarnab, it's an accounting thing. So basically, whatever we have spent on B30, that needs to be absorbed within the year. So whatever kind of some bit of an year-end adjustment, and over and above that, the 12 crores that Navneet mentioned kind of takes care of your question, I think.
Okay, got it. So fair to assume that next year, with mix stabilizing, we can maybe go back to, what we were seeing in the first 9 months?
Yeah, I think guidance is something that we have stayed away from. So don't want to make any guess on what exactly the next year would look like. Having said that, maybe Navneet, you would want to expand on.
On the overall margin side, we have discussed in past that the commission we pay on the book is lower than the commission on flows. So new flows will result in some level of dilution. And then the pace of dilution was quite rapid in the financial year of March 22 because the gross flows as percentage of beginning of the year AUM was 55% upon and in the current year the same is somewhere in early 20s. It also depends on the AUM of individual strategies. So growth in AUM also leads to some level of dilution. But finally, the way I look at it is growth in AUM and change in asset mix over a period of time will fit of our business, and that is our focus area.
Okay, sir. Got it. If you could also related to the trade receivables and the ESOP costs.
Yeah, I'll take that. So trade receivables, there was just a change in the periodicity of payment. It is a payment cycle from the mutual fund, the fees we receive in the AMC. So this gets paid immediately after the month end. So there is no, that was a one-time change. It will sort of continue now going forward. But that is subsequent to the year we receive that money, so that's not an issue. On your question on costing for the new stock option, so based on the Black-Scholes model, the estimated cost, that is a non-cash charge, which will be debited to the P&L account over the next 3 years due to this new ESOP program, would be around between 55 to 60 crores. Of this 55 to 60 crores, approximately 55% would be accounted for in this financial year. 30%, around 30% is the following financial year, and the balance will be in the year thereafter. Over and above this, we will have a debit of around 18 crores from the existing ESOPs already issued, which are going through our P&L. Hope that answers the question.
Yeah, very clear. Thank you very much. That's all from my side.
Thank you. The next question is from the line of Kunal Thanvi from Banyan Tree Advisors. Please go ahead.
Yeah, hi. Thank you for the opportunity. So I had 2 questions. One was on SEBI, Chairman recently did a press conference and they kind of gave out a thought process of the regulator in terms of TER. And the basic understanding is that the regulator wants to move from say scheme based TER to asset class based TER. So wanted to understand your thoughts on the same. How does it impact AMCs and specifically large AMCs which have got very high equity book to start with, and we being in the top 3. So that was my first question.
So Kunal, firstly, regulator has of course laid down their thought process. Having said that, through industry forum, we are engaged and looking at all implications. We as an organization have decided to put on our thinking hats once the regulations are formally out. SEBI chairperson did give an overview of their thought process in the post-SEBI board meeting press conference that you would have heard. She did mention that they will do the necessary in consultation with the industry. I'm sure you will agree that SEBI's overarching objective is investor protection and market regulations coupled with market development. So I would say regulations are a given. As an organization, we need to make it sure that we do what is fair for our stakeholders.
Sure. So basically now, like when if at all that regulation was to come in, then that is the time when we will try to think how the things will go out. Because the reason I ask this question is from a value chain perspective, how does everything flows if those kind of regulations were to come up, because it in a way disrupt the entire value chain, right?
So now there is nothing beyond what I have already stated that I can expand on at this point in time. And sure. I hope you appreciate the same.
Sure. Makes sense. Yeah, the second question was on, the LTCG introduction for the, long-term debt mutual funds. Can you help us understand how does, that impact the industry and HDFC AMC, and what was our exposure to, specific 3-year and above, debt funds?
Yeah, so the Finance Bill has proposed an amendment in the tax laws effective April 1, 2023, whereby investments in a specified debt mutual funds where equity exposure is not more than 35% of total corpus in domestic equity shares, that will be treated as short-term capital asset, and the proposed amendment will have the impact of fresh investments made on or after April 1, 2023 will not get benefit of cost indexation and concessional long-term capital gain tax rates. Gains will be treated as short-term capital gains by default and taxed at the slab rate irrespective of the holding period. There will be no impact on investments that have been made up to March 31, 2023. As much as we would have liked the tax advantage to continue, given the policymakers' view on the development of the debt market, particularly bond market, debt mutual funds still do have some inherent benefits, which in my opinion will continue to make them a preferred alternative. One, that tax gets triggered only on redemption in case of debt mutual funds. Second, there's no prepayment penalty or liquidity-related challenges. I think debt funds offer good liquidity. Thirdly, the flexibility in terms of par redemption, moving across rate or credit curve. I think transparency on all of that, and also the flexibility that you get of the debt funds. And a diversified portfolio of securities with outstanding long-term track record at the industry level. So for all the news of securities going bad, the total equivalent of NPA from the debt MF industry has been negligible. So we still think that there is scope for growth. But I must repeat what I said earlier, that as an industry, we would have liked the tax advantage to continue, because I think we were contributing and we have tremendous potential to contribute to the development of the debt market, particularly the corporate bond market.
Sure. And in terms of, the share of corporate and retail in the 3 years and above, what would be that mix for the industry or for us, if we can share that?
So Kunal, there is no number which basically is like in that form, right? So we do have in our presentation the breakup between the corporate and retail investors or individual investors as we put them across. But I think there are lots of corporates who stay long. There are lots of individuals who might use it for a shorter period. And like we do have corporates who do tend to stay for very long, even in ultra short and those kind of funds.
Sure, I understand. Thank you so much. I'll get back in the queue. All the very best.
Thanks, Kunal.
Thank you. The next question is from the line of Devesh Agarwal from IIFL Securities. Please go ahead.
Thank you, sir, for the opportunity. So firstly, I wanted to ask, although we are seeing a good market share gains on the equity side as well as on the SIP side, but somewhere they are getting offset by the loss in the market share on the debt segment. So can you give me some sense as to why are we losing market share on the debt side? What are the challenges for us out there?
So our market share in debt on QAA basis for March 23 stood at 13.3. If we look at market share excluding debt index funds, this will stand at 14.6% or so. I must mention we were a little late to launch debt index funds as we were waiting for some clarity in regulation and got off the ground once that was clear. So the delay in launching debt index funds did hurt us, though we were able to catch up to an extent. Other than that index fund, in most of the other categories, market share would have been stable to better.
Understood. Okay. And so on a full year basis, could you share the AMC yields and the gross TRs for the three key asset classes, that is equity, debt, and liquid?
No, I think Naozad, he just wants yields for equity, debt, and we give that, no?
Yeah, 70
basis, Devesh is on equity side.
728
7 odd basis on debt and around 12, 13 basis on liquid.
Sorry, I missed for debt.
27 basis.
Right. And Shimil, what would be the TR numbers for the same segments?
I don't have
blended TR
TR available offhand. I'll give it to you. We'll send it across to you.
Sure. And lastly, if we see the OPEX for FY23, that's roughly 14 basis point. So do you see there is any scope for any improvement on the cost side, especially given that now again on the ESOP expense, there will be some almost 25-30 crore hit for FY24. So still, but the growth that we saw on other expenses in FY23, you think those would be continue or there would be some moderation in that? And on overall basis, this 14 basis point can come down to 13 or something.
Devesh, I think Naozad will expand on this, but just one point here. See, there will be no incremental 25 because if what Naozad mentioned, right, the total cost is 50 odd. Of that, first year would be 55 odd percent. And then what we have from the previous one. But in the current year, that is March of 23, we had a non-cash expenditure of 40 crores anyway hitting the book. So the delta would be much lower than the number that you are mentioning. But Naozad can further expand on cost.
So I think if we go through the cost, Devesh, on the employee cost side, if we take out the non-cash expenditure, i.e. ESOP cost, the employee cost for last 3 years CAGR is about 8% and YOY was 9.5%. If you come to other expenses, the CAGR for that over the past 3 years is around 6%. Now let's try and look at it from an absolute number point of view. Our other expenses were 1954 million in March 20. And for the current year, they were 2326 million. So that's an absolute increase of 372 million over 3 years. So we have spent 37 crores extra over March 20, right, for a 3-year period. And of the 37 crores that I'm referring to, 10 crores actually has gone up due to CSR expense. So if we exclude CSR expense, we have spent 27 crores extra over the last 3 years, a CAGR of less than 5%. On a YOY basis, the increase in cost was attributed to business development, NFO spend, IT and digital infra spend, and marketing. So needless to say, we have been and will be prudent when it comes to expenses, but at the same time, we will not abstain from investing into the business in future. On your 14 basis point question, I think some of the heavy lifting that we have done on the IT and digital side has gone through this year. I think we normally don't give guidance on that, but we would believe that we should be able to at least maintain the 14 basis point going forward.
Understood. Okay. Thank you so much.
Thank you. This question is from the line of Pujan Shah from Consortium Advisors. Please go ahead.
Hello, am I audible?
Yeah.
Yeah. First question would be on the, let's suppose if we compare YOY, the industry has gone overall of 6%. Overall, our revenue has gone out 2%. Now, as we have reach on every pin code and almost every, like we have penetrated all across India. So what are the strategic initiatives we are taking to get a better trajectory growth coming years ahead for HDFC AMC and better revenue growth model for that?
You are saying the growth is lower?
Yeah. So year-on-year revenue growth.
That's on the debt side because of the debt index fund. I think our equity market share has been inching up, which is a heartening feature. Our SIP market share or the systematic transactions that we disclose, which includes SIP and STP, that market share has been inching up. And as you rightly mentioned, I think we have a large platform presence across 228 our own branches and a large distribution network, and trying to make the most of it. Our performance has improved. Product approvals from different distributors or the advisors has been improving, and we are trying to. I mean, we have been investing on our digital assets, on marketing, on various other initiatives, and which have started paying fruits.
Oh, okay, got it. Thank you, sir.
Thank you. The next question is from the line of Lalit Deo from Equirus Securities. Please go ahead.
Yeah, good evening, sir. Thank you for the opportunity. So, sir, I have two questions. So, firstly, on the improvement of the performances of major equity schemes. So, we are saying that in major schemes, we are back to like quartile 1 and quartile 2. So, now in terms of flows, so how has the market share improved across different channels, like be it direct channel or a distributor-led channel? Can you comment on the same qualitatively?
So you are absolutely right. I think our performance across most of the categories is top tier, and I think our investment team is being complimented for sticking to their belief despite living through periods of underperformance, and I'm sure you appreciate that this is easier said than done. We have been working on increasing our systematic transaction book and have seen decent results, which I also spoke earlier. As you asked that how it's been showing results in various numbers. I think if you look at our number of unique investors, that has grown to 6.6 million, and that's an increase from 6.3 million in previous quarter. Across the industry, the number of unique investors has increased to 37.7 million, up from 36.7. So during this quarter, nearly 1/3 of new unique investors chose HDFC mutual funds. Systematic transactions, Simar talked about earlier, has increased from 12.3 billion in March 22 to 17.1 billion in March 23. Systematic for us, include both SIP and STP. Of course, we also had a couple of new thematic funds, Business Cycle and MNC fund during the year. But I think most of our strategies which have a good long-term track record and of course have shown very strong performance recently. They are clearly resulting in improved market share. And it's across channels. I think your question was on channels. So I think whether you look at direct, you look at national distributors, you look at our MFDs, look at other banks, I think almost across all channel partners we are seeing improving trends.
Sure, sir. And then one more thing was so at this point of time, since we are seeing some performance improvement also, and now with change in control of the promoter also, like from HDFC Limited to HDFC Bank, so do we see that the share of flows which is coming from HDFC Bank to HDFC AMC should increase over the period of time because of our performance improvement also? How do you see that cross-sell potential over the next FY24 and FY25?
So I mentioned earlier, we are definitely excited about the opportunity and look forward to working closely with HDFC Bank on the distribution front. And given that we have top quality products across asset classes, we are confident of further wallet share from HDFC Bank.
Sure. Yeah. Thank you, sir.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal Financial Services. Please go ahead.
Yeah. Hi, good evening, everyone. So firstly, do you think that there is a market for hybrids between having 35% to 65% equity that now that they have they still continue to enjoy the indexation benefits?
I think funds will have to get sold on their merits. I don't think just because of the tax treatment there would be a certain category which I think the industry would like to push. I think we have products for, as I keep repeating the same sentence, funds for all investors' needs, and I'm sure different investors, depending on their needs, their time horizon, their liquidity preference, return expectations, and the risk appetite, they would choose different products.
Okay. Sir, and secondly, on the cost front, if I look at sequentially from Q3 to Q4, there's a good decline in the other expenses or overheads. So how should we read that? Is there anything specific that you would like to highlight out there, and whether this is sustainable run rate what we've seen in Q4?
I think quarter on quarter is we should not be tracking quarter on quarter, but effectively in the last quarter we had lesser NFOs, business development expense was slightly lower. Certain CSR spend was in Q3 versus Q4, so it's that's the primary reason for the drop from 66 crores to 58 crores.
Okay. Another question was on
year-on-year basis more. I mean, not every quarter.
Okay. Got that. And the other part of the SEBI's discussion was on the broking charges that the AMCs pay. Could you highlight as to what are the broking charges as a percentage or bits of equity AUM that we would have paid in FY23?
No, I don't think I can discuss that.
Okay. And whatever the commentary has been around it to be included in the TERs, do you think that would impact us in what way?
Us means Paresh, you or us? No, but on a more serious note, I mean, if brokerage is included in TER, it will definitely be a regime change. And I think, all of us will have to deal with it accordingly. We will do what is in the best interest of our unit holders and other stakeholders. So I think it will be prudent to strategize on the same once we know of exact regulation.
Interesting. Okay. Thanks. That's all from my side.
Thank you. Next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, good evening. Just two questions from my side. One, just going back to the yields, you mentioned it was a factor of some unabsorbed cost and accounting impact on B30. And second was, bearing that less pace, it was also some product mix change. So if you can just, kind of qualitatively give some understanding of the B30 impact, and also, what would be, or if maybe quantify the impact of the product mix change during the quarter. Second, on the expense part, again, going back, given that you're focusing on rolling out your non-mutual fund strategy, and also kind of spending on the tech side, and how do you kind of intend to maintain the current cost ratio? If you can give some color on that.
I think first point, as you understand, right, how the B30 accounting works. So basically the B30 spend is accounted for, and then over a 12-month period, it gets amortized. Now, if we are not able to do it as per the SEBI formula, right, there is a formula saying that what percentage of sales is happening from B30, so on and so forth, the balance need to be absorbed in the TER. So there was some adjustment in reference to that. So that was the B30 thing that we refer to, Dipanjan.
Sure. On the expense side?
So expense, I think we've mentioned that some amount of spend that's already gone through this year, some of it will continue going forward. So I don't know exactly what you're looking for, because we don't necessarily give forward-looking guidance.
No, sure. I just wanted to understand, what will be the incremental quantum of spends on the rolling out the non-mutual fund strategy, and if that will be material to your overall P&L?
Dipanjan, that would just not count. It will be very, very minimal. And I think most of that in terms of setting up of our AIF and the related costs in reference to legal, accounting, tax, all of it has already been taken care of. So we don't anticipate anything material on that end for sure.
Sure. And just maybe one question, if I can slip in. Your product pipeline for FY24? I mean, just wanted to get some understanding, will there be any NFO spends that kind of on the equity side that can come up?
So we will be doing few NFOs, not many. And I think if you kind of recall, right, I just kind of referred to that NFO as a percentage of the net sales number in FY23 has been at a pace lower than as compared to FY22. Most of the standard categories, we already tick the box. Even in terms of sectoral and thematic, we've been able to expand our product portfolio. On the passive side, we've kind of done a slew of products, both on the ETF as well as on the index platform. We don't expect many more NFOs to see the light of the day during the course in terms of high spending kind of NFOs. We would continue to expand our portfolio on the sectoral thematic side.
Sure. Thank you and all the best.
Four categories, I think our product bouquet is almost full. I think we mentioned earlier we had 8 NFOs in FY22. We had like 25, including a lot of passive funds in FY23. Yeah, there would be few sector thematic funds here and there, but I think our product portfolio is almost full. We have absolutely best in class when it comes to active, absolutely best in class when it comes to passive on the product side.
Got it. Thank you and all the best.
Thank you.
Thank you. Participants, you may press star and 1 to ask the question. The next question is from the line of Srinath V from Bellwether Capital. Please go ahead.
Hi. Just wanted to find out, what was the equity yield contraction year on year? 70 bips was the number for the current year, but what was the kind of equity yield contraction?
A year back, late 70s?
No, I think 723 because of... See, actually, difficult to kind of look at it, and anyway, it will not tell you anything for future. That's what we can tell you, because what happens is, whenever there is a contraction in yield due to increased AUM, that tends to have a follow-on effect over a period of time, whereby that kind of neutralizes itself. So, but I think
more not from the future, but largely want to reconcile the current numbers. If you actually see the yields reported for the year have not changed much, but because of the mix change, we're not able to see how yields are moving to reconcile the gap between asset growth and revenue growth.
We'll get back to you on this number. Do we have it offhand here?
Mid-70s and now we are earlier.
I think we have moved from mid-70s to early 70s for the weighted average AUM of the year.
Okay. This for equity, right?
That's right.
Yeah, perfect. And given the kind of gross flows you guys have had, especially because of the share gain in the last 12 months, would it be kind of fair to assume that large part of this repricing where our back book had significantly lower payouts is kind of either, we are like halfway done or we are largely done? How do you see this, book repricing? Because if now like 70% of the assets we hold are assets that are like, 2-3 years old, then the repricing should be largely done, right?
Well, we have mentioned this earlier. This is dependent on multiple variables and difficult to predict. It depends on what part of AUM is going out, more recent high-cost AUM or the older AUM. And we also have to factor in the mark-to-market impact. So mark-to-market impact versus flows. So gross sales as percentage of outstanding AUM also guides the speed of dilution. So we've been asked this many a times, but honestly, we ourselves find it difficult to put a precise number. The endeavor is always to have better retention of the existing assets, at the same time continue to get higher share of the gross flows.
Got it. Navneet, any views on stock buyback, given that we are now going to see an equity dilution coming in a business like ours, which ideally needs no capital? Wanted to understand what is your broad take on buybacks, as well as do we need any specific SEBI approval over and above what any other normal company would need to do a buyback?
So, I mentioned earlier on the overall payout ratio or the usage of capital. This is something that we keep discussing in the board. This time you would have seen, I think we have enhanced our payout ratio. Have we discussed specifically buyback? Not really. But yeah, all options are always open.
Okay. And the last one is, would it be possible to quantify the brokerage payout in value terms? Because, as we try to assess what is the likely risk that we are going to face. So I'm not asking you what the law will be or how you will deal with, but would it be possible just to disclose the value number so that at least we can figure out what is the value at risk?
I think it will be prudent to, think over the same once we know of exact regulation. Yeah, there's no point speculating at this point in time.
Okay, thank you.
Thank you. Next question is from the line of Kunal Thanvi from Banyan Tree Advisors. Please go ahead.
Yeah, thanks for the follow-up. Can you help me with, what is our, yield for the new flows that we are getting? Did we see any improvement in the competitive intensity in this quarter? And are we seeing some improvement in the new, yield for the new flows that we are getting? That is question number one. Second is, from a longer term perspective, if you can help us understand the remuneration, policy for the company, because you've seen ESOP coming back. How does one, kind of equate between the variable pay and ESOPs with ESOPs coming in, and also at what level we'll be, giving the ESOPs? Will it be the company-wide, and what would be the impact on the variable, salaries that we see in one of the quarters during the financial? Will that kind of subside because of the ESOP? How should one look at it?
Sure. So on your first question on the commission payout trend, I think we've been saying for past couple of quarters that things are getting better. If you observe the direct line TER of recently concluded NFOs, they are much healthier than, say, NFOs launched, say, a year back. And even non-NFO flows are coming in at better margins. In fact, actually, I mentioned this earlier, that a low direct line TER due to high commissions hurt distribution fraternity in medium to longer term more than anyone else, as customers may opt for direct plan if the difference is materially large. And most of the distribution partners do understand and appreciate the same. Your second question on the ESOP side. So as Simal mentioned in the opening remarks, our NRC has approved grant of 10.5 lakh ESOPs to the eligible employees. You would appreciate HDFC Group has been a strong believer in culture of shared ownership and aligned interest. And we believe by giving employees a stake in the company, they become more invested in the success and are further motivated to work towards achieving the shared goals. People are our biggest asset. This business is all about people. And on the distribution and other things that you asked for, so we have engaged services of a big four firm for advising us on this. This is broad-based, covering more than 50% of our people. Dilution is less than 0.5% over a 3-year vest period. And I think Navzad has already mentioned about the financial impact and accounting impact of this, right? Yeah.
Sure. The reason I was asking this was, of course, our industry is people based, and once we issue ESOP to 50% and more of the employees, does it mean that there will be the variable payouts that we make because of the performance link? Will that kind of smoothen up, or that continue to be the way it has been over the period of time?
I mean, we consider all of that in the NRC and of course in the management team when we look at the fixed pay, variable, and then of course the ownership through the ESOP plans. And I think Navzad mentioned earlier that if you look at a 3-year CAGR, it's been like single digits. So yeah.
Sure, got it. So, and last question, if I can squeeze in, is on, Navzad mentioned that, we strive to maintain 14 bits in the total cost that we have, right? Now, when we look at, our business and the way, things have been moving, it is probably, very apparent that the yields would kind of come off, right? And since it's an operating leverage business, one would, believe that the cost per AUM could kind of also come down, and hence the falling yields could get subsided by that. Now, can you throw some light on how do we think about our cost structure, not from a year perspective, like 5-year perspective, in terms of in relation with the AUM growth? Because given the fact that our TER will kind of come down with the increase in size, cost, as a percentage of AUM will decide what kind of profit growth, we as a company would achieve in next 4, 5, or maybe 10 years from now?
So I think if you take it over a long-term period, and operating leverage, as you rightly said, is a focus for everyone. So if you say that over a 3, 5, 10-year period, our ender would be that our costs grew at a slower pace than the AUM. And if by that mathematically the basis point should come down, right? So that obviously is the endeavor for the business.
Okay, sure. Thank you.
Thank you. The next question is from the line of Abhijit from Kotak Mahindra. Please go ahead.
Hey, hi, good evening. First is a broad industry question. I think there was another guideline that SEBI put out around the responsibility of mutual fund trusts versus the AMC boards. So anything to read there, because it seems like SEBI is probably wanting to give more strategic decisions to the trust rather than the AMC board. So does that change things in a material way in the way the business runs, in terms of how performance is looked at, in terms of how fees are charged?
So of course, I think both the trustee board as well as the AMC board look at all of these things. The performance is closely tracked, the fund performance I'm talking about, and all the other things related to risk management, compliance, variety of other things. Of course, as I mentioned earlier, SEBI's overarching objectives have been market regulation, investor protection, and they keep doing lots of things to ensure that the industry performs well, take care of the unit holders to the best of our ability over a period of time.
No, what I meant is generally in terms of being able to, let's say, make more day-to-day decisions around, let's say, what fees are to be charged, how to ensure better performance, if that requires any changes anywhere in the business. On all those aspects, do you see anything materially changing in the way the business is run today?
The way business is run, whether materially changes that, no.
Got it. Second one, again on fees, again just a broad question. Amongst the industry, is there an industry view on whether the industry is sort of making more money than what is desirable or what is justified? And I mean, of course, I may not have put that question in a right way, but is there a consensus in terms of what's the right level of profitability across different buckets of AUM sizes that the industry operates in today? And how are you sort of putting it across to the regulator?
So if I remember correctly, the combined PAT, the aggregate PAT of the industry was around 8,000 crores, and we are managing 40 lakh crores, so that's 20 basis points. But that profit would also include other income, and so if you adjust for that, operating level would be around 6,700 odd crores for the industry. On a 40 lakh crore, that's how much? 16 basis points. Up to you, I mean, when you compare with, let's say, the business we run, whether 16, 17 basis points is too much to us, not really. I think.
Got it. Sorry, in terms of a follow-up, it clearly, like the larger guys, including HDFC, do have the benefit of the profitable back book. But would it be fair to assume that the regulator would not look at it in a very negative way compared to where the rest of the industry is? Because, I mean, just in terms of how the fees would be arrived at.
I mean, you would appreciate the hard work that would have been put over 2 decades to build that book and to get to this profitability. It's not easy to serve millions of investors, creating long-term, wealth for them. Tens of thousands of distribution partners across the country, I mean across 228 physical locations, serving like close to 98, 99% of pin codes, delivering the performance that we have delivered over 2 decades plus. I mean, if you look into that, all of that,
no, totally with you.
See the profit number in that context, yeah.
Got it. All right. Okay. Thank you so much.
Thank you. Next question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Hi, good evening, and thanks for the opportunity. So first is on the net yields on non-NFO business, the non-NFO flows which are coming to you. So if in the current quarter you are getting, say for example, 60 bips hypothetically on your equity AUM. So what was this number for non-NFO equity flows for the last quarter versus year over year? That is first. And the second is that given that the industry is going hard on the asset managers, so what is your view that, are they also, given the kind of commission payouts which are happening in the industry right now, so is the regulator even looking at at the profitability of these distributors and the kind of back book which they have? Those are my two questions.
So on the commissions on the incremental flows, I think we have answered that. I think the environment is improving a bit, whether you look at the NFOs or the non-NFOs in the industry. The second question was on, I missed that.
Distributor, the regulator going, how is the regulator looking at the commission payouts for distributors?
Actually, the chairperson had kind of clearly stated, right, let the industry decide on how they want to manage that. So I don't think, at least our understanding, limited understanding suggests that the regulator will not kind of get to that level of discussion. At least that's what chairperson stated at the press conference.
Right. And sequentially on the non-NFO flows in the equity segment, there's no dip in net realizations. Is it fair to assume?
On commissions have gone down. See, net realization will be a different story, because what happens is when what tends to happen is if the AUM crosses that 5,000 crore multiplier, you will see a dip in the revenue. But if you're looking at dip in commission over a period of last 12 months, as Navneet mentioned, we have seen numbers get marginally better from where they were.
Got it. Thanks.
Thank you. Next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi, thanks again. Just on the AIF thing, you mentioned that you have raised 400 crores of commitment. What are the other plans with regards to new launches over the next 1 or 2 years?
So Prayesh, this is our first one. So I think as of now we are focused on this one. Maybe over a period of time we'll kind of further expand our product portfolio when it comes to AIF. But I think as of now we want to focus on building this one to the level next.
Okay. And this is another question similar to one which was asked earlier possibly. But if I look at your ROEs that have come down from 35-36% range to now 25%. Also, do we look at this from a profitability of a AMC, say 2 years, 3 years down the line? Do we think that this could say trend upwards in some form going ahead in any way? But it doesn't appears to be the way the regulatory moves are kind of coming across. It doesn't seem that the profitability in terms of ROEs could really trend on the higher side.
The ROE is driven by the base effect there for us, given that we have a large balance sheet. So, of course, as we increase our payout, as we have been doing it structurally the last 2-3 years, but the ROE impact will be there just because of the base effect largely for us.
So, because the margins have also gone down, and that would have also played out. So it was more from that perspective, and then the balance sheet size has gone up. But it was more from a margin perspective. If you look at, they have kind of come off. So from a longer term perspective, do we see that returning anytime soon?
It is around 35 basis points. So I've been over the last several quarters, 35 basis points.
Actually, Prayesh, see, profits have grown. So basically, if you're looking at ROE, means we definitely appreciate your question on margins having gone down. Yes, that has been the case, right? And I think Navneet did make a mention that our margins are kind of governed because of the book being at a different price and the flows being at a price higher than the cost of the book. So yes, margins are going down. but that would not have any kind of direct impact. So ROE is nothing else, right, but profit divided by the net worth. And out there we are sitting on slight bit of an extra cash. See, the way we see it is we are a infinite ROE business theoretically in sense. Today, apart from what is required by regulation in terms of the skin in the game circular and the minimal net worth criteria of 50 crores, everything balance is sitting on our balance sheet. If that is not there, then of course our ROE will look very, very different. But yeah, with you on the margin side, I think our business has undergone a bit of pressure on the margin side over the last few years. On the regulatory front, we honestly don't know what's going to really play out. Having said that, if you rewind yourselves to 2019, right, I think we did see a regulatory change, and post that we've been able to kind of tackle things as it is. So I think let us see how this comes up and we'll decide then after.
Sure. Thanks a lot.
Thank you. The next question is from the line of Atul Mehra from Motilal Oswal Asset Management. Please go ahead.
Yeah, thank you. Good evening and thanks for the opportunity. So just one question in terms of, like, typically the way we see it is on the mutual fund business, the regulatory issues like we discussed on the call are generally increasing in terms of fee pressure and so on. So while in terms of it might not contribute very much in the near term, but would you want to, from a medium to long term perspective, incubate a private equity venture capital business where the long term value that you can derive is much higher, although near term obviously it will not move the needle given how large our public markets business is, but the profitability and the scope there could be much larger when you look at it from a long term perspective. So any thoughts on these two businesses?
You shouldn't look at a business from more regulated or less regulated. In fact, the regulation on alternatives, as you would be aware, is also changing. I mentioned earlier, wouldn't comment much on the regulation side, but we remain committed that over a period of time there are tremendous opportunities in this business. Our mission is, I've repeated it several times, is to be the wealth creator for every Indian, and that includes, an SIP of 100, 200, 500 rupees per month, somebody who's contributing that, to serving the ultra HNIs and family offices and institutions who are looking at maybe other kinds of solutions within the asset management business. We are building capabilities across the board. We have been best in class in terms of our product range on the active side, significantly expanded on the passive side. So as that market grows, we are absolutely ready to capture that. And on the alternatives, as you mentioned, the first product on the fund of fund has been launched. So far, I think we are pretty happy with what we have done on both sides, building capability on the investment side as well as our reach to the investors. I think over 200 investors have participated in our first close. That's very, very heartening. And over a period of time, we would like to build that. We have launched 2 strategies on PMS, and over a period of time, there will be opportunities on that side. Our subsidiary on the GIFT City, I think another a quarter or two, once we start, once that's fully set up, we will look at launching products both for global investors who want to invest in India, and at a later stage, even providing opportunities for domestic investors through the LRS route to invest globally. So, we want to capture the every possible opportunity on the asset management side, and I don't think the lens through which we will look at is like what is more regulated and what is less regulated. We really appreciate, I think, the way regulators have played their role in India. I think tremendous credit to them for the market development over the years. I think Indian capital markets, I'm sure you'll agree, are one of the most, I would say, robust, I think one of the most liquid and transparent markets. And over a period of time, transparency really helps in building trust among the investors, all kinds of investors. So whatever regulator does, I mentioned it earlier, even at the cost of repeating, apart from market regulation and investor protection, they also have an objective of market development. And we are all hopeful as an industry. We engage with the regulator, with other market participants on how do we grow together for the, I would say, betterment of investors and of course for the growth of the economy over a period of time.
Right. Great, sir. Thank you and all the best.
Thank you. The next question is from the line of Gaurav Jani from Prabhudas Lilladher. Please go ahead.
Thank you for taking my question. Just wanted to understand from a mix perspective, in terms of equity, direct and indirect, are we materially different from the industry?
Our equity mix is better than the industry. I think on the closing AUM, the equity was 56% of the total assets. On average, it was 54% of total assets. Industry would be 49%. Yeah, 49%. So yeah, it is better than the industry.
No, so I meant actually the direct contribution in equity versus the industry. So that will be about 80-20, right? I mean, 20 direct and 80 indirect. So.
Oh, on the management fee is same in both direct as well as in the distribution plan. Yeah.
Understood. That's it.
Thank you. Ladies and gentlemen, that was the last question. I will now hand the conference over to Mr. Navneet Munot for closing comments.
Oh, thank you.
Thank you very much. On behalf of HDFC Asset Management Company Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.